Good day. Thank you for joining me. I'm Ryan Quinn, and I'm going to be taking you through Woolworths Group's year-end results. Looking at our recommendation, the food operation has been the most attractive. Though the impact of the strained consumer in the medium term is a concern for the food operations, it is unlikely to remain the engine for growth as it has been historically. Clothing and merchandise has suffered from a cyclical downturn with a decrease in margins. David Jones has a struggling business model which is under pressure from online competition in Australia. This resulted in a 6.9 billion rand impairment in the current year, with further impairments looming if earnings do not increase. Individual divisional struggles as well as a highly levered balance sheet increase the downside risk. Struggling trading conditions and negative cash flows place pressure on future dividend cover not being as high as it's been historically. The share price does seem attractive relative to historic multiples and peers, but the potential downside risk is higher than what we have been accustomed to. This is primarily due to the execution risk in its Australian strategy and the highly geared balance sheets. As a result, our recommendation is underweight, and we recommend a portfolio guidance of 0% while we wait for evidence of recovery of trading conditions. Moving on to some key financial highlights, looking at the debt. Net debt to equity increased to 90%. Total liabilities increased by 4.2%, while total assets decreased by 10.7%. Net debt to EBITDA increased to 2.5 times. This indicates an increase in balance sheet pressure due to a higher debt burden. WACC is 10.4%, while return on invested capital is 7.29%, which indicates investments are not generating the required returns to cover the cost of funding. Looking at our earnings, results were disappointing. Locally, this was due to a depressed economic activity and consumer confidence, while in Australia it's due to a lower footfall in shopping malls and a consumer shift to online shopping. Turnover was down by 2% at 75.2 billion. Adjusted EBITDA was down 10% at 7.5 billion due to the poor performance of David Jones and clothing. HEPS was 13% lower at 364 cents. While earnings per share there was a loss of 369 cents. This was due to the David Jones impairment of 6.9 billion rand. The full year dividend was 24% lower at 239 cents per share. Looking at the cash flow, they generated good trading cash flow of 7.3 billion. After cash flows to service tax, finance costs, and capex maintenance, the free cash flow was 3.5 billion. This leaves little room to pay for cash expansion and dividends. In order to fund these costs, debt had to be increased. There's going to be large capex expansion forecasted for financial year 2019. The dividend cover will have to decrease due to these cash flow constraints, and if this is not the case, the debt burden will be increased. Looking at our portfolio guidance, the Capswix rating for Woolworths is 0.96%. We recommend a portfolio exposure of 0%. If you would like to place a trade, please speak to your financial advisor or contact the trading desk. A comprehensive company analysis on Woolworths can be found on the PSG online trading platform. Before we end off, I'd like you to please take note of the following disclaimer. Thank you.